Hello, everyone, and welcome to another episode of the Weekly Tanker Market Podcast. I'm Trisha, your host, and I've got to say I'm pumped about today's episode. It's the fifth week of 2025, and there's a lot happening. So I'll be welcoming Sandesh to explain us all about crude, CPP, and the LPG market.
Thank you, Trisha. Thanks for welcoming me here.
All right, Sandesh. So let's first talk about the crude segment. Could you shed us some light on the VLCC segment?
Well, Trisha, ex-MEG, that is Middle East Gulf market. Last week, market started on a downward trend. It was due to the increased competition amongst ship owners and kind of a surplus of available vessels. So we know that the Lunar New Year festival was there last week, and it kind of further weighed on the sentiment. And with the expectations of reduced cargo inquiries, the market has seen downward trend. So as the last week progressed, the market remains stable with kind of ample tonnage supply and uncertainty over whether rates would drop further below by psychological the world scale 50 threshold. And when the week was kind of reaching its end, we have seen that rates strengthen as a tonnage list tightened with the several ships. They started ballasting to the Western markets, and it is kind of a limiting charters options. So despite Lunar New Year celebrations in Asia, market activity remained firm with strong demand for kind of a eastern going voyages. And looking ahead, we think that the market is expected to remain steady next week, and with XMEG and East rates, that is for Far East China rates, they will likely hover around world scale 60. So now in the XWAF segment, XWAF is West Africa, and here also last week market started on the kind of a bearish note with a lack of fresh fixtures and weaker sentiment spilling over from neighboring markets. So, rates, they were continued to decline for 6 consecutive days and returning to levels seen before the US and UK sanctions on Russia's energy sector. So, by the end of the week, market kind of strengthened further, and it was driven by increased demand for eastbound cargoes and ongoing arbitrage opportunities. So, market kind of on a similar note, similar like my Middle East Gulf market, it started on a bearish note, but by the end of week, market was bit surge. And looking ahead, we think that here also in the West Africa market is expected to stabilize next week with XWAF Far East rates. They were hovering around low to mid world scale 60 contingent on the cargo inquiry levels. Now talking about ex-US Gulf, last week market experienced mixed movement throughout the week, and with the minimal fixing activity at the start and previously traded levels kind of proving unachievable. So freight rates, they continue to decline, particularly after fresh testing from Brazil with the market indications aligning at world scale 52 for ex-Brazil China, and it was estimated around 8.5 million for ex-USG China voyages. So towards the end of the week, sentiments kind of turned bullish when the market started reappearing from the Lunar New Year holidays, and with freight rates strengthening driven by a prompt fixtures, kind of a 9.1 million for ex-USG China. So although the entire market not considered fully market reflective, kind of a subsequent indications traded higher, and with that it's suggesting that an upward trajectory for both ex-USG China and ex-USG UKC routes.
Thank you, Sandesh, for that really insightful update. Now that we've talked about VLCC, could you also tell us what's going on in the Suezmax segment?
Well, in the ex-MEG, that is Middle East Gulf market, last week market started with a limited activity, kind of similar sentiments with respect to VLCC market, with no fresh inquiries emerged for the eastbound or either westbound voyages. Towards the end of the week, market sentiments improved kind of as activity picked up with stronger demand for both eastbound and westbound voyages. So the rise in cargo inquiries tightened vessel availability for mid-February loadings, and it further supported by a strengthening VLCC market. So in the XWAF, last week market saw an initial surge in reporting fixtures, and rate kind of increased, but there were limited due to kind of a downward pressure from the other sentimental pressure from other segment like VLC. So as the week progressed, the market faced headwinds from sluggish inquiry levels and kind of ample tonnage supply and it kind of a pressurized rates, and it continued the weakness in the VLCC sector with around a kind of a 15 vessels available for prompt for loading, and it was impacted the Suezmax segment. So while we have reached the end of the week, market again gained due to this rebound of cargoes from Asia because of finish of this Lunar New Year holidays, and market participants they are coming back into the market.
And how about the Aftermax segment? Are they following the same trend, or is there something different going on over there?
So, they were also following the kind of a similar statement or similar segment because ex-MEG market saw little movement with limited activity and few reported fixtures. And even in the ex-SEA last week, market remained very subdued with limited activity due to Lunar New Year holidays. So while early inquiries and kind of a replacement voyages, they kind of provided some support, but the overall sentiment, it kind of stayed flat as fresh cargoes failed to emerge in the significant numbers. So we have TD14 index, it saw marginal gains before stabilizing, and it reflecting a lack of movement in the market. So the expanding tonnage list coupled with minimal trading, overall it suggests the short-term downward pressure on rates, but however, expectation remain for increased activity post-holiday, and that could help drive momentum and establish the clear market direction in the coming days.
Thank you so much, Sandesh. That was a really good breakdown for the crude segment. Now, let's switch it up a bit and talk about the CPV market. Could you tell us what's going on in the LR in the MR segment?
Well, in the LR segment, particularly in the LR1, the freight rates on XAG Japan route for TC55 benchmark route, there was a marginal decline last week compared with the week-on-week sentiments, and it slipped by around world scale 9.37 points and settled around 124.38 world scale points. At the same time, we have a LR2 benchmark route, that is TC1. It was also decreased by around 12.78 points, and it got settled around 124.72 points world scale. In the MR segment, I would like to mention this that TC17 benchmark route, that is AG East Africa route, it remained flat around world scale 185.71 points with week on week. But in that particular segment, we have seen earning, they are marginally inched up by just $177 per day, and they were ending around $50,000.521 per day, just below the break even. Now, talking about the Indian CPP exports, they were kind of a mixed performance across refiners because we have seen RIL, Naira, they were kind of a decline in export, but that is on week basis because mostly these exports were down because of there was a lesser activity due to Lunar New Year holidays, and we expect that market will bounce back in the coming weeks. So now we have one special mention about the jet fuel because we have seen, the global CPP product, it was growing and the entire demand of CPP product segment, it was driven by jet fuel, and it's kind of a cornerstone for, incremental oil demand growth, and it has faced kind of a protracted recovery in the post-pandemic era with demand persistently lagging behind pre-COVID-19 levels of 7.9 million barrels per day that recorded in 2019. So despite the projections for 2024 and 2025, which kind of forecast consumption reaching around 7.4 million barrels per day and 7.57 million barrels per day respectively, demand kind of expected to remain over 4% below the 2019 peak, and it kind of underscores the sector's sluggish rebound. At the same time, the geopolitical and kind of economic headwinds, they have compounded the challenges with, Europe's stagnant economy and delayed aircraft deliveries constraining passenger capacity, while China, they are one of the Asia's primary demand driver. They continues to underperform with jet fuel consumption at 0.84 million barrels per day compared to 0.88 million barrels per day in 2019. So together, I like to say that, or my perception is that international flight to and from China, they needs to be increased, and they need to be increased above the pre-pandemic level. Then only we can achieve this high growth in the jet fuel segment.
Thank you so much, Sandesh, for that fantastic rundown on the CPP market. I guess we'll have to see how the CPV market performs as we enter into February now. All right, now shifting gears a bit, we haven't talked about LPG market yet. So what's happening over there? Are we seeing any significant changes or any major trends that you'd like to mention?
Well, thanks, Trisha, for LPG segment and thanks for the question. You know, the East of Suez freight market, they had a busy week last week and we have seen 8 deals concluded for February like ends. So Indian utilities took the market by surprise. They securing an above average share of spot deals and which led to a rise in the BLPG1 index early in the week. The latest India discharge deal was reported at $55 per metric ton and the February AG spot fixtures count is now 15 and it close to the 3 month average of 16. You know, it kind of a leaving uncertainty about whether upcoming cargoes can maintain the positive trend. So, you know, activity remains subdued due to the Lunar New Year with Indian cargoes they fixed in the low to mid 50s dollar per metric ton and a number of February relates are still available and owners are hopeful for more cargoes to materialize. Now, talking about the West of Suez freight market, it kind of experienced a very quiet week with only one fixtures reported. So, freight rates they kind of remain stable in the mid to high 90s per metric ton for Houston Chiba. That is a benchmark route, and it's specifically going through the via Panama. So, there are still 6 to 8 firm February vessels need to be fixed, and likely covering the remaining cargoes. But however, a persistent oversupply to end February USD tonnage is expected to surpass the market post-weekend. So owners are hoping for a solid number of end-month cargoes to prevent an overhang of available vessel as the market enters the March fixing window. So overall, the sentiments are kind of busy and we may see further increase in the sentiment levels and increase in the cargo and fixture levels in the coming weeks.
Thank you so much, Sandesh. It's going to be really interesting to see how all of these trends that you just mentioned about all of these segments, how they're going to play out as we move deeper into the year. And with that, I guess we wrap up today's episode. A huge thank you to you, Sandesh, for sharing all of your expertise with us.
Thank you, Trisha, once again for inviting me here.
And of course, a big thank you to all our listeners for tuning in. Do not forget to share and follow us to stay up to date with all the latest market insights. Until next time, navigate safely and stay informed.